John Okocha and Eric Bodiwala here with us from Elevate Commercial Group. They do multifamily and commercial investments pretty much all across the U.S., and we are super excited to have both of them here to teach today's webinar for you. Without further ado, let's get right into today's presentation. I'm super excited to have both John and Eric with us here, joining from Dallas, Texas. Elevate Commercial Group, you guys have had some really awesome things going on. It's been exciting to see you guys grow over the past couple of years, and I'm excited to see what you brought us today. So go ahead and take it away. If you guys in the audience have questions, put them in the Q&A box, and we'll come back on at the end and answer that Q&A for everyone.
Thanks, Haley. Appreciate it. First and foremost, can you guys see my screen?
We can, yes.
Okay, perfect. All right. And I'm looking at the camera. I'm just looking at a couple screens here. So anyway, thanks to Haley and the entire team at Quest for having us here today. We really appreciate the opportunity. And, the main reason we're here is to just deliver some type of value, right? We hope that after us talking here for, 30 minutes to an hour, you have a takeaway, and that can help you in your business or in your retirement or you personally, whatever it may be. So that's going to be our job today. So John and I are going to try to do the best to do that, and we'll take it away. So our company is Elevate Commercial Investment Group. Kind of a little slogan that we have is increasing value and elevating wealth, right? So I talked about delivering value. And I think everyone wants to elevate or increase their wealth, whether it be personally or financially. So that's what we're going to talk about today. So just to start off with a disclaimer, I think Haley kind of covered this already, but, we're not giving any type of legal or financial advice. Consult the professionals to do that. We provide opportunities and share knowledge, and it's up to you to do your own due diligence, as to what you decide to do with your investments or, overall, the direction that you head in. So anyway, wanted to just point that out really quick. So who am I? I'll start off with just introducing myself. My name is Eric Bodiwala. I'm one of the managing partners and founders at Elevate Commercial Investment Group. My role is really the chief operations officer and making sure that the wheels are always turning. I've been in the real estate business for going on 14 years now. Started my real estate career in Miami, Florida. That's originally where I'm from. Been in Dallas 12 years now. Started off with single family, a lot of wholesaling, a lot of fix and flips, a lot of rentals. Been involved in the multifamily space for about the last 3.5 years now. Been investing in apartment buildings passively for the last 5 years, but then started taking a more active role the last 3.5 years as far as multifamily real estate. And it's been a nice ride. It's definitely an interesting transition. From single family to multifamily, and a lot of people always talk about that, but there is a little bit of a learning curve, but we're here to do the best job to explain exactly what that is. So I currently own and manage 125 million under management. All of our properties are in Texas and Oklahoma. We have 2 properties right now that we're working on closing by the end of the year in South Dakota. For those of you wondering, South Dakota, not many people talk about South Dakota, but it's an excellent market. It didn't actually shut down for COVID whatsoever. No mask mandate, no nothing. They're business as usual over there. So check it out. It's interesting. Right now I'm an active general partner in about 1,720 units. Once we close these next 2 transactions, it's 265 units and another 165 units. So that'll put me just over 2,000 doors, which is pretty cool on the active investor side, in just over, a little over 3 years. So excited about it, proud about it, but still a lot of work to do. And, John shares ownership in some of those apartments as well. And I'll pass it on to him so he can introduce himself.
Hey guys, my name is John Okocha. I'm the VP of Acquisitions for Elevate Commercial Investment Group. I've been in multifamily now for over 2 years now. Been doing a lot of acquisitions with Elevate. just in the past year or so, we bought over $90 million worth of acquisitions and raised over 23 million in equity for our apartments. So we're really excited about the information we're going to provide to you today, and looking forward to providing some value.
Awesome. So we'll go into the next slide, which is really our mission statement and kind of what we're all about here at Elevate. And that's really I'm just going to read it because it is really a statement. It's to serve and improve the quality of life for the residents of our communities. Notice we say residents. We don't call them tenants, right? Tenants is kind of looked down upon. I mean, these are people, right? These are people that are looking for a good place to live, and they bring their families, and they just want a high quality of life just like everybody does. So anyway, to serve and improve the quality of life for the residents of our communities while bringing quality investment opportunities that deliver exceptional returns and grow the wealth of our investor partners, right? So we're really looking to improve the quality of life of our residents and our investors and of our own. It's really a win-win-win scenario across the board. And we have that little image there and says, "What's your why?" Well, personally, the reason I've always enjoyed doing real estate is because I enjoy helping people. Whether it's buying a house from them, when I first started, and getting them out of a difficult situation, or providing them a place to live, whether it be a single family rental or an apartment building. You get joy and satisfaction of that, and when sometimes people are in difficult situations and you can provide them just a home, they're very grateful. So anyway, that's our mission statement here at Elevate, and it's really our why. And I consider myself a passionate person. I think all of us here at Elevate are pretty passionate, and we try to stick to that when it comes to the reason why we're doing this business and what we do on a daily basis. So I will let's get into the nitty gritty of it, which is why we're here, and I'll let John take it away here.
All right. So we're going to talk about the 7 benefits of investing in multifamily real estate. So just starting out, so what is a multifamily property? So a multifamily property is 2 or more residential units within the same building. So these are your duplexes, your fourplexes, your 10plexes, pretty much anything over 2 units. Let me get into the benefits here.
Yeah, and what I would add is, obviously anything, like John said, is like anything over 2 units. I mean, I think mainly what we focus on is 100 plus units, and we'll get into it in the presentation today, but you'll see that managing 2 to 4 or even 50 units is more difficult than managing 100 plus units. Give me a second, John. I'm going to give you this control here, or I can, hang on. I'll be the slide mover and we can talk. So here we go. Benefit number 1.
So our first benefit, investing in real estate. So with multifamily, it gives you increased cash flow. So multifamily properties are always in high demand. This demand creates an opportunity to invest in an asset that generates monthly cash flow that's spread across multiple tenants. This translates to a higher monthly revenue, which ultimately increases the overall value of the apartment building.
Cool. Actually, I don't have really anything to add there. I guess we'll go into benefit number 2 in a second. All right, so I'll talk about this one, John. So affordable acquisition cost. It's funny, like typically we're buying apartment buildings for anywhere between $30,000 per unit to maybe $65,000 per unit, right? That is our sweet spot as far as active general partners, as far as where we like to buy. And really, if you think about it on a cost unit basis, I mean, that's really more affordable than what you could buy a house for. There are some areas of the country, we're here in Dallas, you can buy houses for 10, 20, 30 grand. It may not be in the best areas, but you can. I think the cheapest house I ever bought was like $2,500, which is insane. But overall, apartments are typically cheaper than buying single family or other types of real estate. One thing that we like about the multifamily game is that the foreclosure rate on apartments is typically lower than what you see in single family. One thing that blew my mind when I first got into this business and I started taking a more active role in multifamily is that Fannie Mae and Freddie Mac, and those are the guys that basically produce most of the loans for these apartment buildings, and they'll give us 75 to 80% on these buildings. These are non-recourse loans, right? So, what does that tell me, right? Like, if you buy a single family home and you have a $30,000 mortgage, right? And for whatever reason, you don't make, a few payments, that bank is probably going to foreclose on you and probably going to make your life a living hell and ruin your credit, right? With apartments, they're non-recourse loans. So if something goes bad, they don't come after you personally, which blew my mind. And I started thinking about why that was. And really the reason is because they don't care about the individual. The asset is so strong that they're like, the heck with Eric and John, we don't need to focus on them. We'll just take back the asset because there's so much value there and we're not going to lose our money, and we'll just continue to maintain it and improve it. So that's one thing that really, surprised me about multifamily. I mean, you can get literally $100 million loan and it's non-recourse, right? I can't imagine if you did that for a single family residence, what they would make you sign up with, right? Maybe your children, your wife, it'd be pretty incredible. But anyway, kind of an interesting fact about multifamily. And then, as a result of kind of these things that I'm talking about, typically you see lower financing rates, in multifamily properties, which, helps, right? It reduces your operating costs and it brings more revenue into your pocket. So anyway, just a couple things there. So we'll go to the next slide and John will talk about that one.
So added to the lower financing rates and lower financing costs, it also brings lower operational costs. So not only are you having low operational costs, you're also moving into the side to where they become easier to manage as well. So when it comes to having 100 units or 100 single family properties, it's easier to manage the 100 units because they're all under the same roof. So it's a whole lot less stress. You're not driving around the city. You're not having to talk to multiple tenants or in different locations. And it's a whole lot less addresses that you have to worry about.
Cool. Let's go to number 4. So one of the biggest reasons, and benefits of investing in multifamily is the tax breaks. As you can see here in this image, taxes suck. Nobody likes to pay them, right? I know every year come April, well, actually this year was delayed, right, because of just the pandemic, but nobody likes to pay them, and they're tough, right? So we want to find out ways to receive tax breaks however we can. So when you invest in apartments and in multifamily, the government actually rewards you for providing housing to residents of a given city, and that's anywhere in the United States. And they provide these tax incentives specifically to multifamily. I'm don't quote me on this, but I'm pretty sure that of all the asset classes, real estate has the most tax incentives because you're housing a ton of people. And it really is an amazing thing. When you get tax breaks, you keep more money in your pocket, and that's really what it's all about. And it's funny because, for example, in some of our deals that we do, if you invest $100,000, sometimes you can write off up to 70% of that investment. And again, I'm not a CPA. We use a cost segregation company that we use to do all of our tax stuff, but and sometimes you can even write off dollar for dollar, of that investment. So basically you're not getting taxed on any of that money. So it's really incredible what we do. And every time we buy a property, we do a cost segregation study, and basically they evaluate the depreciation of the property based on, age, what you're going to put into the property. And the government allows you to sometimes accelerate that depreciation where you can get most of that depreciation in year one. And that's how we're able to save a ton of money, in taxes, right? And that's really the number one reason why people invest in multifamily, And one of the benefits is because of the tax breaks. You know, I know a lot of our investors are, you know, professionals, engineers, doctors, lawyers, even some just regular blue collar people, you know, and everyone's looking to cut their taxes and you know, however they can. And, you know, I know that's one of the biggest reasons that people invest. I know these last two deals that everyone was, you know, was really keen on, hey, is this closing in 2020 so we can take the tax breaks this year versus next year? So anyway, we use Madison Specs. They're actually here in Dallas. You know, they're a great company, and they do the cost segregation studies for each and every one of our properties. But it's kind of cool that the government incentivizes you for buying these properties and giving a roof over, you know, many people's heads. So something kind of cool about multifamily. We'll go on to the next one.
So another benefit is the high appreciation rate. The value of multifamily properties, they increase over time. And this increase depends on the location of the property and also if it's very well maintained. We strive to maintain our multifamily properties at a very, very high level. We also have a construction company which makes it easier since we're vertically integrated. So this gives us an edge over a lot of other investors and when it comes to actually maintaining the property and making sure that everything gets taken care of.
Yeah, and just to add to that, you know, it's important. You ever been to an apartment building or just anywhere, and you're like, why is there trash everywhere? Why is nobody maintaining this place, right? You know, people realize that, right? If I walk into a place and I'm looking, you know, personally, I live in an apartment building. I live in a luxury apartment building here in downtown Dallas, and you know, if I walked around and I saw trash everywhere, you know, I'm probably not going to want to live there, right? I'm OCD, you know, like I like to have a clean place. You know, so you got to make sure that you maintain it, right? Just having trash around the property, you know, or anything of that nature, you know, keeping the grounds clean, keeping the landscaping fresh, all that stuff is very, very important. And at the end of the day, you know, it's only going to help you maintain your tenants, right, or residents, and it's only going to help maintain, you know, the value of your property. You know, so appreciation is everything, but you have to. Appreciation can happen, you know, organically on its own, but there's so much behind the scenes that an operator does to make sure that appreciation continues to go. Anyway, so I just wanted to add to that. So we'll go on to the next slide. Benefit number 6. So really overall, you know, with multifamily, you know, there's really less investment risk, you know, over other types of properties. You know, even single family, you know, the only risk that you have is like your vacancy factor, right? So there's a couple things that we look at when investing in multifamily. Like, for example, you know, if there's like, we own a property in Lawton, Oklahoma. You know, that's the Fort Sill, you know, military base is right there. And, you know, typically we don't like to have, you know, higher than a 10% military, you know, occupancy in the property. Why? Because if for whatever reason, you know, there was a deployment, we would lose, you know, a ton of our residents. You know, I've seen some, you know, operators have 20, 30, 40, 50% military, you know, in their apartments, you know, and, you know, it's high risk, right? You know, so you want to make sure, or, you know, even another example is if at a particular apartment building, you have like one main employer, right? So what happens if, you know, that employer goes out of business, right? You know, obviously this has been a difficult year for everyone, and, you know, a lot of people have been shutting down their businesses. But what happens if that company goes down? You know, all those people that, you know, you provide a home for don't no longer have a job and, you know, can no longer pay for rent. You know, but for the most part, if you mitigate those risks, the risk of, you know, complete vacancy is relatively low, right? Normally we like to operate our properties at about 90%, 92%. If you're probably in the upper 95% or more, your rents are probably too low. You know, so that's something that we always try to maintain. But anything above 90% is great, and, you know, with occupancy above 90%, you're able to get better financing as well. Something that's here on the slide is, location, right? You always hear in real estate, location. Look, and what's going to happen, right? In a time like this, and what we invest in is B and C multifamily properties, right? A is really luxury apartment buildings. B is, just under that. C is probably, more blue collar. And what happens, right? When an economy goes down, A-class people go to B, right? And B goes to C. Most people don't make the dive and go to D. That's really lower income, which is kind of in a class by itself. But, that's why we focus on B and C multifamily, right? Because they're in good locations. Some people are always going to need a place to live, and even when the economy's down, and, people need food, water, and a place to live at the end of the day. So, if you do a good job maintaining your property, it's going to grow over time. So we like to, the reason that we invest in multifamily is because there's just less risk. Anything can happen with, one unit, single family, right? If we're investing in one house, if I have, 5 rentals and, all those people lose their job and I lose all those tenants, there goes all my income. If I have a 100-unit building and I lose 5 tenants, I can manage that, right? It's not that bad, and it's not that much of a dip. So that's about it for benefit number 6. We'll go to benefit number 7.
Yeah, and with less risk, banks are willing to lend more money on these properties, so higher LTVs on these properties. So that brings us to benefit number 7. With higher LTVs, that means there's less money to put up front, which allows you to purchase more properties in a shorter period of time. This creates an opportunity to boost the rate of return on your money and potentially double your money at a faster rate if you were to invest in other asset classes. So, and not only that, but this process is skyrocketed when you pool other funds together on an investment or a down payment.
Yeah, and it's kind of funny, wouldn't you rather go to 1 closing instead of 5? Well, I guess it's how you look at it, right? 5 closings sounds good, but if you're closing on 5 single family homes, or you could buy 1 apartment building that has 5 units already, right? Why not do that? You got 1 roof to deal with instead of 5 roofs. It just makes it easier. A lot of people think, oh, well, the single family business will be a lot, easier to maintain, or I just don't understand it. But, personally, you buy 1 building up with 1 roof and a lot more units, it's only 1 closing, right? You got 1 property manager. Sometimes when you have multiple properties, you have to have multiple property managers, and you're driving all over the city. So it just makes it a little bit more challenging. Sorry about that. Went to the other slide by accident. So anyway, so really those are the 7 benefits. This is really kind of general stuff, guys. We didn't want to go into too much detail, but we want to talk to you next about, and those are really the 7 benefits that we had. And, overall, they're pretty good benefits. But we wanted to talk about really like passive investing, through multifamily syndication. And basically what is, multifamily syndication? It's, we're buying an apartment building, and there's equity needed in order to buy that apartment building, because we can get a 75 or 80% loan from the bank. So we're going to need 20 to 25% equity. And then we go to different investors and say, hey, we'll give you a portion of this property. We'll pay you a high rate of return and give you equity in the deal. We're going to operate it, and we're going to probably sell it in 5 years, and we're going to do a profit share in the cash flow and the equity, right? And that's basically what multifamily syndication is. So, myself and John are multifamily syndicators. So we basically group investors together, collect money from people, in order to buy these apartment buildings. But as you can see in this little, graph, it says passive investors fund a portion of the equity, investment of apartment syndications. You guys have limited liability, which is great, right? You're just passively investing. You don't have to, trust me, this stuff is hard work. If you're and you can take either side, right? You can be on the active side like us, or you can take, more of the passive role. But, there's a lot of things behind the scenes that we deal with, dealing with property management, dealing with construction management. It's tough, and there's a lot of pressure, on it. And on top of that, we have to, report to our investors, right? We need to make sure that everybody's happy. I talked about this. Typically, you get a preferred return, and you know, the investors are always paid first, right? We don't take a dime until our investors are paid first. You know, because typically our investors are putting the majority of the money into the deal, and then, you know, we put up, you know, probably 10% of the deal of the equity required as well. But anyway, we have to align interest between passive investors and general partners is key, right? We want to make sure that we're on the same page and that our investment goals are the same. You know, we don't like to invest or do business really with anyone that, you know, we haven't met personally, right? You know, we like to create a long-term relationship with people and make sure that we're aligned, right? And that we're going forward. You know, and I think that's super important. I kind of talked about this already, the profits. You know, sometimes we'll split 50-50, sometimes you'll see 70-30 splits, sometimes you'll see 80-20, and when the number's higher, it's usually in favor of the investors, you know, which is great. And then distributions are, you know, either paid monthly or quarterly. Monthly isn't you know, very typical. You know, these apartment buildings, they take a long time to turn. You know, typically they're about 5-year holds. So, you know, normally it's a quarterly distribution, but you know, if a property is operating well and it's a little bit more stabilized, sometimes that can switch over to getting paid monthly. So, you know, why passively invest? You know, really, you want to get your money working for you, right? Just focus on your career, whatever it is you do, your day job, you know, whatever career you may have, and let your investment work for you, right? It's all about, you know, working less and, you know, having your money be smarter for you. You know, when you passively invest, passive income that earns above average returns. I'll talk about this here, but typically you know, ourselves or other syndicators will pay a 7 to 10%, you know, preferred return, and then do, you know, 70-30 or 80-20 splits. And really peace of mind for your retirement and leave legacy wealth for your family. You know, I think that's what it's all about. You know, I don't personally have any kids right now, but I know when I do, you know, I want to be able to leave something for them, right? So if I could say, hey, here's a few apartment buildings that cash flow like crazy, you know, I think they'd be set. I definitely don't think I'd hand everything to them right off the bat, because you know how that goes. People need to learn how to appreciate things, but anyway, I think that's important for all of us. And then, you know, obviously reaping the tax benefits, which we talked about. Nobody likes paying taxes. How are we doing on time here? 12:37. All right, we're not bad. We got probably about 10 more slides and we'll be wrapped up, and then we can take some questions and stuff. All right, so Robert Kiyosaki says, you know, the rich don't work for money, they make money work for them. Couldn't be any more true, right? And that's the reason that I passively personally invest, right? In addition to our properties, right? Because, you know, the money that I make, right? I want to make sure that, you know, if I'm not putting them into our own deals, that, you know, I'm putting them into other people's deals that I trust as operators that can perform, right? And have a good track record, right? So Robert Kiyosaki is a great guy, you know, wealth of knowledge, and, you know, I'm sure many of you have read his book, Rich Dad, Poor Dad. It's a great book. If you haven't read it, I would highly recommend you read it. I kind of talked about this already, you know, but basically how does syndication work, right? Here's our apartment building. I'm not sure if you can see my cursor. I think you can, but, you know, we're buying a building for, you know, $1.5 million. You know, the bank will give us, let's say 75% of that, right? So they'll give us a loan for like 1.125 million. And we'll have to raise roughly $375,000, right? So we'll reach out to, you know, family, friends, or just investors, you know, and say, hey, you know, would you like to, you know, share in, you know, profit share in this deal? We'll pay you a 7% preferred return, and, you know, we'll give you 70% ownership in this deal. And normally, you know, in syndications, you'll see that they'll pay the investment is really anywhere between $50,000 and $100,000. You know, some investors invest, you know, more than that, 150,000, 250. Some investors invest 500,000. You know, we've seen some investors invest a couple $1 million, you know, in apartment buildings. You know, some use 1031 money. Some use IRA funds through Quest. Actually, that's, you know, obviously the main reason we're here is, you know, Quest. And, you know, a lot of people use their retirement funds to invest in apartment buildings. So, you know, so getting this process, right, is tough, right? Because each individual person, we need to make sure that we have a relationship with, we connect with, we're aligned with, and they understand exactly what our objectives are. And they have to understand the property. So it's a complete alignment, right? It's almost like a marriage, right? If you and your wife aren't properly aligned, things are going to go south, right? So communication is key, right? For everything from the very beginning. So we try to do a thorough job of that, up front. And other apartment syndicators do the same. And if we're not aligned, then it's probably not a good fit, Look, and I always tell people this, if you're not getting the warm and fuzzy feeling about people, right, and just in general, you probably want to look the other way. And that's in anything, right? I mean, maybe even if my server at the restaurant isn't giving me a warm and fuzzy feeling, I kind of get a little weird, like, oh, maybe this guy's going to mess up my order or something. So that's typically how it works. So you go to the next slide here. So we got general partner versus limited partner. So basically when we take on an apartment building at Elevate, we're a general partner, right? We'll own, 30% of the apartment building, and then the passive investors, the limited partners, they own typically 70%, right? And that's really how it's structured. And the general partners really, they're the ones that make the decisions for the property, do what's best for the deal, for the apartment building, and do what's best for our investors, right? And we take that seriously. That's super important because, we're playing with a lot of money here. If you're buying a $50 million apartment building, that's a lot of equity that you're raising, and a lot of retirement money, a lot of, family money, a lot of, just livelihoods that people are depending on us as general partners to do so. So we take that very seriously, right? We will always do what's best for our investors and what's best for the deal. Because at the end of the day, if ourselves or other, apartment syndicators don't take that seriously, that's when relationships and bridges, can be burnt. So anyway, that's just kind of how it's broken down. I'll go to the next slide here. Oh, sorry, hang on here. Mouse is, okay, we kind of already talked about this, 30% equity, 70% equity, general partners, passive investors. I don't want to talk about that again. We've already discussed that. So typical returns for passive investments, multifamily syndication, kind of already mentioned this already, but you'll get a 7 to 10% preferred return paid quarterly or monthly, which is great. Obviously, if you know that you keep your money in the bank, it's not really doing much. I mean, I don't even know what they're paying nowadays. Less than 1%. Typically in apartment syndications, when you invest passively, you'll see like a 1.5 to 2x equity multiple. So that means that if you invest, simple example, if you invest $100,000, as a passive investment, you'll receive $200,000 back in 5 years. So you'll get back your $100,000 plus an additional $100,000. And that is really broken down into cash flow. It's a combination of the preferred return, the cash flow of the property, which is paid either quarterly or monthly. And then if there's a refinance, right? If there's a refinance and, the income of the property has increased and, we're able to cash out money, right? We'll pay off the underlying debt and then distribute that remaining equity to the investors. If the property needs operating funds, then, we'll put that money into the operating account, and again, always doing what's best for the deal. But these are the typical returns that you can see, in over 5 years. I mean, that's pretty good. Typically people buy, their homestead home, right? And they think, all right, well, I'll keep this house for 10, 20 years and, sell it, for maybe $100,000 or $150,000 more in 10 years. I think, obviously, at least in DFW, in this market, the market's kind of crazy. Prices have been soaring. Dallas-Fort Worth is one of the number one markets. It is the number one market in the country. So people are making these types of returns in shorter amounts of time, but it's not always there, right? This is a secure way of doing it. And it's a great investment over a 5-year term. On top of that, you're getting your tax benefits. Let's see where I am here. So go on to the next slide, and we're about to wrap up. It's 12:45, and we can open up for questions and stuff. But really, when you're investing in multifamily, you have to either decide, do I want to be an active investor or do I want to be a passive investor, right? Do you want to do what John and I do, which is all the dirty work, right? Some people don't want to do that. Some people just want to say, hey, here's my money. I want to earn a high rate of return. We trust you. Keep me informed. Let me know how it's going. And, I want to look at my bank account every quarter and make sure that my distributions are there. And then once we sell the property, let's all get together for dinner and celebrate because we all made some money, right? Or you can take the active route, right? Which is, what we do, and, worry about where to find the apartment buildings, underwriting these apartment buildings, which typically take several hours. John will tell you that, we'll get on Zoom calls or we're in the office, just analyzing a deal, figuring out what we can get for rent, visiting properties. We were just in West Texas, took a 10-hour trip to look at 411 units. That was last week, doing everything that it takes to do it. Dealing with contractors, right? Having the painter say, yeah, I'm going to be there at, 9 a.m. and he doesn't show up and ghosts you. And then you have to explain, to your investors why, it wasn't painted or why you didn't meet that timeline, right? All that stuff goes into the active investor role. But that's why we're compensated, right? Because we do the dirty work, and sometimes it can be a kick in the butt. It's tough, and things don't go always as planned. But you got to stick to it and be, persevere and be diligent, and it always works out. So you can always take one of the two routes, with investing. So I guess we'll just open it up to questions or comments. I think we're about done here. I wanted to point out a couple things. This is our website. If you want to come check it out, there's a ton of great stuff there. When you go to our website, you'll probably see my partner George on there. His face is everywhere on social media. I kind of play the under the radar role, and so does John. But Elevate CIG is our website. There's a ton of great content there. We have a free ebook that we'd like to give everyone, and it's really the benefits of investing in multifamily real estate. It kind of goes a little bit into some more detail as far as what we talked about here. So you're welcome to go to this link here, and then 3 questions to ask deal sponsors before investing. Right. So these are questions that you would ask myself or John or my partner George before investing passively in an apartment building. So we think that those are great questions to ask, and we wanted to provide those to you guys. So I'll leave this slide up here for a minute, and then on the next slide, I'll leave our contact information for myself and for John, our cell phone numbers and our emails if anybody cares to reach out for any questions or comments, or if you just want to get to know us. We're always an open book. We like to deliver value. Hopefully we've delivered some value today, and if we haven't done so, we failed terribly, but I think there's got to be at least one takeaway that each of you have taken away today, hopefully. So with that, I think we're about wrapped up. So Haley, if you want to take it away.
Yeah, definitely. We've got some great questions that have come in so far. Guys, I did put those links there in the chat for you. Be sure to check them out. They've got some great resources for you guys, but let's get right into the Q&A. Fred wants to know, do the tax advantages and incentives associated with multifamily properties apply to only new construction or also existing properties that are purchased?
That's a great question. It's actually applicable to all types of multifamily properties, whether it be new construction or like a value add deal. I'm not certain on this because we don't really play in the Class A space and new development. We would like to do some new development, but I would imagine that you're not going to get as much depreciation because you're building brand new, right? You're not improving the property, you're building it, right? So you're probably not going to get as much of a break as far as what you can depreciate. So that's why, again, we like to focus in the B and C space. But that is a great question. Maybe talking with somebody that invests with a deal sponsor that invests and operates in the Class A space could probably answer that a little better. But I know with B and C, we are squeezing that orange as much as possible and getting as much juice as possible.
Mm-hmm. Awesome. Another good question here from Troy. Troy wants to know, I have noticed that in many multifamily presentations, the investors in the case studies are usually in and out within 5 to 7 years. I realize there are a lot of tax benefits in the first years, but it does seem odd to me that one would sell a good asset in order to chase the next tax break. How often have you seen this? And this one's in the Q&A box if you want to read it. So I know it's a little long.
Yeah, no, I mean, that's a good question. Typically you want to move on to the next investment, right? Within, 5 to 7 years. Sometimes we're selling these properties. I mean, you can sell properties as quickly as 18 months, right? I'm not sure if anyone's ever turned an apartment building quicker than that, especially a large apartment building. But, you want to get the tax benefits because you can get those. The best tax benefits are probably in the first year. After that, they start to trickle down. But really it's just, for the most part, we're getting investment money from our investors, and typically people want to get their money back, right? So if we invested in a deal or bought a deal and said, from the beginning, okay, well, this is going to be a long-term hold, right? And people are okay with leaving their money in there for a while, then great. That could be something that we pay down over time. But typically that's the reason we're getting in and out. It's not so much the tax benefits to jump to the next tax benefit. It's more so that we got to get everybody's money back, right? And people want to exit and move on to the next deal. So it's just kind of the cycle that, is with multifamily and the territory that it comes with. So I think you're getting the most depreciation and tax benefits year one. Those will start to trickle down as we go. But really it's a matter of, we got to get that money out and move it to the next investment. I'm not sure if I 100% answered that, but, if anything, email me and we can discuss about it more.
Yes, definitely. Let's see. This is another good question here. Richard wants to know, are you expecting any distress in multifamily markets in 2021? What markets will you be considering?
That's a great question. John and I and our team, we talk about that all the time. Right now, the government has still been cutting, checks and stimulus checks and writing money. And, some people think that, the worst is yet to come. I mean, I don't know. We live in a disaster of a world right now. If I had a crystal ball to tell you exactly what was going to happen, but, first quarter of 2021 may take a little bit of a dip, right? If they stop cutting checks and, I don't know what's going to happen with the election, but, what we've done on our end to kind of mitigate that risk is just communicate with our tenants, right? And our residents. I keep saying tenants. I always mean to say residents, but communication is key, right? If somebody's going to have a problem paying their rent, you have to communicate with them. Put them on a payment plan, whatever it may be. To make sure that we can work that out, right? The last thing we want to do is get them kicked out, or these moratoriums that they have that we can't evict people. It's tough. It makes it tough. So you have to really mitigate that. So one thing that we've done is that we've because we're in the middle of the value add of a lot of our properties, we've stopped distributions because we need to keep more cash on hand. Because if we start losing a ton of residents for whatever reason, or people can't pay their rent, we need to make sure there's enough cash in the operating account, right? So again, it's a team game, right? So we've communicated to our investors that, hey, look, we just can't pay distributions right now. And it's not that we're not going to make up these distributions. We'll make them up. It's just a smart thing to do, right? We're protecting your money. We're protecting the asset. So it's tough. I hope that, everything gets resolved with the election and stuff this year. And, things get back to normal. I think people are praying that come New Year's Eve, everything's going to be normal January 1st, right? So I don't know. That's what my hope is. I think we'll always be fine because multifamily is the strongest asset class. People are always going to need a place to live. It's just about how you handle where it goes. And, if we're paying distributions out like crazy and we don't have any money in the operating account and then something happens first quarter, I've done a bad job as a general partner managing that asset. And then you're going to look to me, yeah, you may have money in your bank account, but then we're in jeopardy with the property. So, it's a matter of managing that and communicating. So hopefully the worst is behind us and, we only continue to improve. But, honestly, I don't know. I can only hope for the best.
Exactly, right? And I will actually use this as a quick opportunity to plug our next big event that we are doing. It's on Saturday, December 12th. We're actually bringing out Eddie Wilson from Think Realty and Richard Wilson from Family Office, and they are going to be doing a forecast of the upcoming year. So that'll be a great event, December 12th, but we do still have several questions coming in here. Let's see. If someone is looking to invest into one of these types of assets, what's the typical minimum that you guys see? Do you have to be accredited? Tell us a little bit about that.
Yeah, great question. So the minimum you see is typically 50,000, right? Like I know our current deals now, we have a minimum of 75,000. The other one's a minimum of 100,000. But as a general partner and as a deal sponsor, you're able to make that judgment call, right? And you can say, look, we can take a couple of $50,000 here and there. We do make those exceptions. But typically 50,000 is probably the minimum you'll see. Because imagine, if we're raising $10 million and I got to collect $10,000 from people, I'm going to have a ridiculous amount of investors. It just makes my life way more harder and tougher to get it done. So as far as being accredited and not accredited, for 506C offerings, which is basically we don't have to have a relationship. I can blind market to you and we can touch base and you can decide to invest. You have to be accredited for that type of offering. We have done 506C before. For 506B, which is we have to have a relationship, we have to have connected at least 3 times. Those types of offerings, you don't necessarily have to be accredited, to do those, to invest in those. So there are opportunities where accredited and non-accredited people can invest. It just depends on, you always have to sign, basically saying that what you're doing. If you're not accredited, you always have to just sign saying, look, I know what I'm doing. I can invest. I understand the risk behind this. Nothing is guaranteed, but you can invest, accredited or not accredited. It just depends on, the offering. And then typically the verification for that is like a letter from your CPA verifying that you are accredited. Or there's a couple websites that like Verify Investor is one way, and they'll ask you for your tax return, so on and so forth, to be able to invest. But that is a great question.
Mm-hmm. Perfect. All right. We've got a few more questions here. Guys, I will let you know if your question is super long and in-depth, it might be a good opportunity to go ahead and reach out directly to Eric and John. Sometimes those really in-depth questions, a little hard to answer here on the webinar. But this is a good one here. Bharat wants to know, how many deals have you done to date? Have you lost money on deals? And about how many average deals do you guys do a year?
Good question. Typically we like to do a deal a quarter. That hasn't happened this year, obviously, just because of the pandemic. I think from like April to June, nobody was moving any money around at all. It was very difficult to do deals. A lot of deals were falling through. So typically a deal a quarter. We hope that in 2021 we're able to kind of push that. Haley, can you repeat those? I kind of forgot the.
Yeah, there are a lot. Let me go back to them really quick. Have you lost money on deals, and how many deals have you done to date?
So right now we own 7 assets, 7 different buildings in Texas and Oklahoma. We haven't lost any money on any deals. We've been in this game for about 3.5 years. So we haven't gone full cycle on any deals yet. So that means that we've bought a property and then sold it yet. We're in the process of refinance several. We refinanced several of our buildings already, and then we're in the process of refinancing several others. But what we do is we like to partner, because in this space, this is a team game, right? The single family game can be done by, on its own, but the commercial space and the multifamily space is really a team game. So what we do is we partner with other co-GPs, and we all raise equity together. And we bring in people that are even more experienced than us, right? And some of the deals that we've done, we partner with people that own 10,000 plus doors and have gone full cycle on deals. So we bring a lot of value with the things that we do with, our construction company in-house and providing value add and raising equity. And then our partners bring in their experience and, property management or whatever it may be. So, so far so good. We haven't lost any money on any deals. And we don't expect to, we fully expect, as long as, we're moving forward, right? The needle's always moving forward. We're moving towards refinancing a lot of our properties, then that means we're always moving in a forward progression. So we're excited to, when the time is right, to be able to sell those assets and give everybody their returns. So far so good.
Nice. Awesome. All right. We'll just do a couple more questions here. Curtis wants to know, how does the bank or financial institution determine the available funding or loan amount for a particular apartment complex and the loan rate? Kind of what is that based on?
I mean, that's all based on net operating income and occupancy, right? If it's anything less than 90% occupancy, then you're going to have to get a bridge loan, right? Which is basically a short-term loan. You'll see those anywhere between 1 and 3 years. As far as a loan term, when you have above 90% occupancy, you can go either Freddie or Fannie and get longer term debt there, typically 5 to 10, 12 years. And you'll have a lower interest rate there, right? So basically, the more stabilized the property, the better financing you can get, and the longer term debt, the longer term you can get with better rates. Typically, if you have a very heavy value add deal and it's 70% occupied, you're probably going to go in with bridge, right, and get a 1 to 3 year note. And typically, like around the 2 year time, you're refinancing into long term debt, holding that for the next maybe 3-4 years until you sell. But it's great because once you buy the property with bridge and once you refinance, you can potentially cash out some money, pay off your investors. And then, typically cash flow increases, right? Like right now we have a property it's a portfolio of properties and we're refinancing, and it's literally going to free up about $150,000 a month in cash flow alone just with the refinance. So we're excited about it.
Nice. Okay, Lewis has a question here. What determines the split? What determines if it's 50-50, 70-30, 80-20? Kind of walk us through that a little bit.
Good question. The split is just, dependent on, the returns, right? Typically, we like to see from a deal level, a 10% cash on cash return. And this may get a little bit confusing because in multifamily, there's so many ways that you can, basically evaluate a deal or figure out what it is, like what the return is. But, typically the biggest thing that I tell people is like, all right, if you're going to invest $100,000, how much am I going to get back, right? In simple terms, right? So we like to hit a 2x multiple or right around that sweet spot. That way you're basically doubling your money within 5 years. And that's really what determines how we split it, right? Sometimes there are waterfalls, right? Well, we'll do 70-30, right? So the investors own 70% of the deal, then 30%. Once we hit, let's say, for example, a 15% internal rate of return, that changes to 60-40, right? So then our percentage increases and then yours lowers, but you've already hit your returns, right? And you're already getting the cash flow that we promised you. Well, not promised, but projected for you. And then we, as operators, we get rewarded a little bit more for doing what we've done, right? So it really just depends, deal case by case. But typically you're seeing 70-30, 80-20 splits. You do see some 90-10 splits, but honestly, I just don't see how that even works. For 10% of the deal, it's so much work for the operator. It just doesn't even make sense sometimes. When things go wrong, it's like, okay, well, the investors may have made money, but the operators don't make any money, and it makes it tough, right? It's got to be a win-win, right? It's got to be fair, and I think, from that perspective, everyone's got to make money, right? And, so anyway, hopefully that answers that question.
Yes, everyone definitely wants to make money in the deal. It's definitely why we're here, right?
Yeah, and to do more deals, right? Like I want to be happy, John wants to be happy, you guys want to be happy, so we can all continue to do deals. But you will find some operators that operate in different percentages, but typically you're seeing 70-30 splits is really what I see across the board for the most part.
Awesome. Perfect. So one last question for you guys. What kind of final piece of advice would you have to all of our audience out there, moving forward into 2021? I know it's been such a crazy year, but do you have any kind of last final closing thoughts, words of advice for all of our audience out there?
and John, you can chime in on this one as well. It's been a rough year. I would say personally, as far as multifamily, look, and investing, always continue learning, right? Get as much knowledge as you can, ask good questions. Don't feel like any question is stupid, and connect with good people. Like when we wanted to get started in multifamily, we really didn't know much about it. We knew single family. So I just started connecting with people that were better than me at what, at multifamily real estate, and it's funny how those dots connected, and, little by little, in a short time period, we're about to hit 2,000 doors. So that would be my advice, and like you guys are sitting here listening to us today, and if it's something that really interests you, reach out, don't take action, right? Reach out and say, hey, how can I connect with you? How can I learn more about that? And that's really the way you excel in not just in multifamily real estate, but just in life in general. So that would be my advice, connect with good people, take action, and ask good questions. John, I don't know if you have anything to add to that, but that'd be my advice.
Yeah, just to piggyback off of that, relationships are key. If there's something that you want, find the person that has what you want and attach yourself to them, offer value to them. That's one of the ways I got into Elevate, is by doing that as well. And even just looking at the deals that we've done, we've done deals with people that have 10,000 doors. We've done deals with people that have hedge funds and have billions under management. And that's all come from having a really good relationship and offering value to people who have what it is that you want in order to get to the next level.
Yeah, and I would add to that, be likable, right? Some people are so difficult, right? Like, be easy, right? If people like you, they want to do business with you. They want to connect with you, right? Like, and I mean, I feel like some people got it and some people don't, and like, I don't know. I mean, especially this year where everyone's dealt with so much stuff, like, take it easy, be likable, try to deliver value however you can. And if you do that, and if you focus on that, and you focus on being resourceful and like putting the pieces together, I think, you can be successful in anything that you do, whether it be multifamily real estate, your family, your marriage, kids, whatever. I mean, that's really the secret sauce for life in general, at least for me. So anyway, but.
Yes, it's all so true, guys. Be sure to reach out to Eric or John and check out those links that we sent in the chat. You guys have a lot of great resources on your website there. So y'all definitely be sure to check those out. We love to bring you good resources from all different